Welcome to Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
We're here today with renowned Econ Professor Ed Burton. Thanks for being here. Today's August 7th, 2024. Professor, the world markets have declined significantly over the 3 of the last 5 days. Everybody's nervous about the economy. Can you speak to what's going on in the U.S. economy and the world economy?
Well, we don't have a lot of data to tell us really what the economy is doing. The most recent flap had to do with the announcement last week of 114,000 jobs created in the prior month, and that sort of shocked the market because they were expecting 175,000 jobs, but those numbers are frequently revised, and by more than you might guess. It wouldn't surprise me if they came in with a revision that was above 200,000, for example. Or they might come in with a revision that's 100,000 lower. Revisions in that kind of data are common because they take very small samples to get that data. And so if one item in the sample it changes a little bit, that can change the number a lot. So there wasn't much news for the market to react like that. The real reaction came because the Japanese central bank raised their overnight lending rate, and that sent the yen higher. The currency in Japan is the Japanese yen. And that sent the yen higher, which meant that their holdings in treasuries were worth less. And if the Japanese start getting nervous that the yen is going to start going higher, that will reduce the value to them of their holdings of U.S. Treasury, regardless of what happens to interest rates. And so they may decide they want to sell some of those. And for example, today we have a $42 billion 10-year auction, which will take place at 1 o'clock this afternoon. If the Japanese decided to sell 10 or 15 billion of their 10 years today, that would cause a real problem for the auction today. Doesn't take a lot at the margin to get these auctions in trouble. And I think that fear that the yen could do well and the dollar could weaken might have had something to do with the difficulties in the stock markets because there was a massive amount of selling. You'll hear that it was the so-called carry trade that led to this. The carry trade is where you borrow in Japan at 0 and invest in the U.S. at 5% in the treasury bill market. So you effectively borrow in Japan. It's complicated, but frankly, it's very easy to do if you're a hedge fund or a broker-dealer or something like that. It's very easy to borrow at essentially 0 rates, or was easy at 0 rates, and then invest that money in T-bills over that same period of time. That's called the carry trade. You're betting that the currencies won't shift against you. But if all of a sudden the yen goes up, in other words, the currency in the country you're borrowing from, because you think it's cheap to borrow, if all of a sudden you have to pay back much more expensive yen at a later date, that causes a problem, and you can lose an enormous amount of money in the yen trade. It's not easy going, but it's a favorite thing that hedge funds love to do, and Wall Street traders with time on their hands and nothing to do but, eat cheeseburgers and look out the window, they occasionally will find themselves doing the carry trade because it's something to do. I don't think that's the biggest thing. The biggest thing is the move in the Japanese yen. The fact that Japan's raising rates and the yen is now going up compared to the dollar, that's threatening because you have a lot of treasuries, $1 trillion of treasuries in Japan, and the Chinese yen also could appreciate in the same manner, and they have almost $1 trillion in treasury debt. And that doesn't sound like much when you think of the debt at $36 trillion, but at the margin, if they decide to sell some of that, it will sound like a lot. Because all that matters is the marginal seller. If the marginal seller enters the market, given how precarious the situation is now in the debt market, it could be troublesome. What is scary, Hunter, is the prospect that we might be entering a recession in a period where we might not get the usual favorable drop in rates. Because of the size of the national debt, there's not an easy coasting back to zero rates for America. That's not going to happen. So the question is, where will the rates settle if we have a recession? If mortgage rates, for example, settle at 5 3/4, that's a long way from where they were pre-pandemic, because we were staring at mortgage rates under 4 and closer, and sometimes under 3. And so that's the fear, that you'll go into recession and you won't have the weapons to do much about it because rates won't favorably come down like they normally do and help you. The debt's just so big, and these offerings are getting bigger and bigger every single week.
Professor, interesting. The 10-year today, the yield on the U.S. 10-year is 3.93. Yield on the U.S. 3-month is 5.22. Yield on the U.S. 2-month is 5.32. Can you speak, please, to your position that the Fed has its hands tied when they can lower rates? Last week, the Fed declined to lower rates. They meet again September 16 and 17. They indicated last week they probably may lower rates in September. You've stated before that they can't lower rates if the yield on the 3-month, 2-month, 1-month is higher or equal to 5.25. What happens next month if the yield remains like it is today? And can you speak to the trade that you and others have done, the arbitrage trade by buying the Treasury and selling in the overnight repo market that prohibits the Federal Reserve from just deciding they're going to lower rates?
Well, Hunter, to see how that works, imagine you're a Wall Street firm and you're looking at the Treasury market, and imagine all the yields that you're looking at are higher than 5 1/4. And they are, most of them. The 1-month and 2-month are certainly higher than that, and the 3-month is very close to busting through 5 1/4. So if you just invested in T-bills, you'd earn 5.30, 5.33, whatever it is, if you invested in a 1-month or a 2-month Treasury bill. Now, the Fed is a lender, and that's the rate it's setting. When it says we're going to lower rates, it's lowering the target rate at which it's willing to loan money, essentially, to banks. And if they announce tomorrow that they're willing to loan money to you at 5 1/4, and you look out there and you see the T-bills at higher than that, then all you have to do is buy the T-bill and borrow the money from the Fed at 5 1/4. And you'll make the difference between 5 3/8 and 5 1/4. That doesn't sound like a lot, but you could go in and do $800 billion of that if you're Merrill Lynch or somebody.
And is that risk-free?
Well, the only risk is that the Fed changes its mind. After it lowers the lending rate to 5 1/4, later in the week says, oh, we made a mistake. We're going to raise it to 5 1/2. No, they don't do that. They're not going to make an announcement lowering rates and then later in the week raise them, or later in the month or next month raise them. They're not going to do that. So there's an obvious arbitrage. If you can buy a risk-free asset at a rate higher than the Fed will loan you money to buy it, and you can lock it in for 2 months, which effectively you can, then the Fed can't really lower that rate without permitting unlimited arbitrage by hedge funds, Wall Street firms, whatever. Now, there's a way around that for the Fed. They could go into the marketplace and buy the 1-month and 2-month in size. They could go in tomorrow and buy $1 trillion worth of 1-month, and believe me, that'll take that rate below 5 1/4. So they could do that, but that would be a huge, massive increase in the money supply, and they don't want to do that, and that becomes public if they do that. So they're reluctant to do that. Now, they have on occasion done that, so it's not beyond the possibility they might do that, but that's doubtful. That would be a sign that they don't really control rates. People would see that. So what the Fed has traditionally done is wait till Treasury bill yields get within the new target range. In other words, they'll watch those Treasury bills, and when they get below 5 1/4, then they'll say, okay, our new target range for the funds rate is 5 1/4. And that's what they'll do here. So if you see the 1-month and 2-month drop below 5 1/4 come next September, then you know they're going to cut rates. Would they cut 50? No matter what all the economists on Wall Street are saying, there's no way they're going to cut 50. To cut 50, they got to push the rate all the way down to a maximum of 5. That sets up all kinds of arbitrage opportunities. There's hardly anything you can do in the bill market that doesn't beat that by quite a bit. So again, they could go buy a lot of those bills and force the rates as low as they want, but they'd have to spend money that would become very obvious. That would inject a huge amount of money in the economy, and inflation would rear its head again. So if your plan is to beat inflation, you don't want to be doing that. So if you really want to know what the Fed's going to do, just watch the yield on the 1 month, 2 month, and 3 month. That'll tell you what you need to know. You see it drop below the fund's target range, then you got a rate cut coming, a target rate change coming. And if you don't see that happen, it's not going to happen.
Federal debt today, U.S. debt is 36 trillion. Federal tax receipts are 5 or 6 trillion every year. Federal debt's going to 50 trillion, whether we like it or not, over the next 6 to 8 years. 50 trillion debt, 5 trillion in receipts, rates go to 10%. There's no money for anything other than debt service. We spend $7 to $8 trillion per year. So would the Federal Reserve just print $7 to $8 trillion a year? And if so, what would be the effect on interest rates and inflation?
That's a very good question, Hunter. It's an interesting question, too, because academic economists and the Federal Reserve believe that inflation is not caused by central bank money printing. They think inflation is caused by overheated economies. So if the central bank, for example, comes in and buys half of the national debt, most academic economists would say it won't make any difference. And the Fed would say the same thing. The Fed, every time they present a paper, every time Powell speaks at Jackson Hole, who's the Fed chairman, he has 20 pages in his appendix to his talk, and they're all charts of economic data. And guess what's not in there? The money supply. It is not in any of the 20 pages. So their attitude is that money supply doesn't cause the inflation, so why not just have the central bank come in? Why not the Fed come in and buy debt at these auctions? Well, that'll work, I guess. It didn't work so well in the pandemic. They came in and bought $7.5 trillion. They increased the money supply by 50%, and the price level today is 30% higher than it was when they embarked on that project just 3 years later, 4 years later. So that may be where we're headed, that the Fed becomes convinced that it can use money printing to keep rates from going up, and so they start getting more involved in the auctions. There's some evidence they did that earlier this year, by the way, because the money supply today is higher than it was a year ago, even though you could get misled by looking at their balance sheet, but the money supply, the amount of money printing has actually gone up year to year. So I think that the likely scenario here is that we're going to have trouble at these auctions, and the Fed will be called upon to actually print money to bail it out. So if you had to guess where we're headed, I think we're headed to more inflation later, not necessarily right away, but looking down the road when the Fed embarks on more money creation, because they don't believe it causes inflation. They're very open about that. You notice next time Chairman Powell does a press conference, go listen to what he says. What does he talk about? He talks about the labor market. The labor market is normalizing. He doesn't talk about the money supply. The money supply doesn't matter to him. But he's wrong about that. If you look at the data on the money supply and the price level, nothing fits better than money over GDP and the price level. And that's not only true for the U.S., it's true for the United Kingdom, it's true for the Eurozone, it's true for Japan, it's true for Canada. It's true for Switzerland. It's true for Sweden. It's true for every country in the world.
You sound like Milton Friedman.
Well, Friedman was the first one to point that out because that was the problem in the 70s, and now we haven't learned the lesson we should have learned in the 70s. We're not very good at predicting inflation, whether it's going to be 5% or 2% or 7%. We don't know the answer to that. But we do know if you increase the money supply a lot, you're going to have a much higher price level. Whether that shows up in a year or 2 years, that depends on the rate at which it goes, which we don't know, but we do know it'll be higher. The problem for the average American today is that when he walks into the grocery store, he doesn't care whether the inflation rate is 0% or 2% or 5 or -3. He cares what the price of the goods he's buying is, and they're 30 to 40% higher than they were just 4 years ago. Now, if he's lucky enough to have a wage that went up by that amount, great. But for many people, the only thing they see is higher rents, higher home prices that they can't buy and can't afford. Inflation is a terrible thing for people that don't have assets, and they're facing these high price levels. The inflation rate is kind of an overused statistic. Nobody cares whether it's 2 or 3 or 4 or 15 or 20. They care what the price is, the price level that they have to pay when they go to the grocery store or to the gas pump.
So why does the Federal Reserve seek to get a 2% inflation rate? Why not 3, 4, 5, 6, or even deflation? What's wrong with deflation?
Well, there's a recent paper on this subject that looked at the help of in the NBER working paper series, looked at the issue of is deflation a big problem? Because the folklore, if you're hanging around an economics department these days, it's MIT or UVA or anywhere, you'll hear one of the great urban myths that deflation is bad for an economy. That what you want to do is avoid deflation. You'll even hear Powell say that, and monetary economists all say that. And it's interesting because from 1865 to the beginning of World War I in the U.S. grew from a war-shattered economy that was struggling to survive to the biggest global economic power in the history of the earth in that period of time. And guess what? Price level fell by a third. We had nothing but deflation. That's how William Jennings Bryan would say, you cannot crucify mankind on a cross of gold. There were no gold discoveries. The money supply was constant, but output increased. So you had deflation. Well, this paper goes through all the deflations that have been done in major countries in the last 50 or 60 years and notes that under deflation, you're as likely to have prosperity as recession. There is simply no connection. And I think the reason we connect deflation with bad times is the Great Depression. People have memories or they've studied the Great Depression, and you did have deflation during that period. But what about the 1870s and 1880s and 1890s, both in the U.S. and England, where economic growth was just absolutely astounding, and you had deflation all through that period? They forget about those periods, and those were some of the strongest. England ruled the world at the time. And the U.S. became the biggest superpower in the history of the world during that time. So it's hard to make much of a case that deflation is a big evil. Deflation is probably a good thing, a bad thing. They should really shoot for price stability. They should shoot for a policy where the value of the dollar is the same today as it was 30 years ago, as it will be 30 years from now. That's what they should be targeting. They shouldn't pick some arbitrary 2% out because they think deflation is an evil. There's no evidence for that. And this paper shows that. It goes through the details of this. There is no research that shows deflation is harmful. But every academic macroeconomist believes it. And it's hard to imagine. But that's not the only bizarre belief that you'll find in macroeconomics. The biggest bizarre belief is the idea that changes in the money supply don't make any difference for the price level. We know, looking at the data, that it definitely does. If you take money divided by GDP and map it against the price level, it's a perfect fit for every major country in the world today and for the Eurozone, for the matter of fact. We've done that. We have a paper we're working on now that takes every single one of those countries and charts money over GDP against the price level. And guess what? It's a perfect fit. So if you increase the money supply, guess what's going to happen down the road? I can't tell you how fast that'll happen. That's inflation. But I can tell you the price level's headed higher, and that's a problem.
Professor, number one question from many of your listeners, without a doubt, not even close, is where do you invest to protect yourself? Can you speak to the 1970s? What worked in the 70s, 1970s U.S.? We had high inflation. Rates rose, I guess the 15%, the 10-year yielded 15% in the early 80s.
The 70s were compounded. The 70s was a period where inflation by the end of the decade was very high, and so was unemployment. So strangely enough, you had a big increase in inflation and a big increase in unemployment. So much for the view that unemployment and inflation are trade-offs with one another. Far from it. They moved up together during that period. But the whole decade was this was the world when the Fed became the biggest topic in the news. And so everyone was watching the Federal Reserve, see what they were doing. And what were they doing? Same thing they're doing now. They're issuing destabilizing comments all the time, shifting ground all the time. The Fed, for example, recently didn't see the inflation coming. 2 years after the inflation hit the American economy, as late as August of 2021, there was Powell saying, this is not a problem. And then 3 months later, he reversed himself. Janet Yellen was famously said when they were considering spending another $9 trillion in January of 2021, right after the Biden administration came in, she said, we need to go big. Interest rates are zero. We can go big. Well, they went big. Her story was there wouldn't be any inflation, but unfortunately, Secretary of the Treasury was wrong. There was a lot of inflation. And Janet Yellen is probably the most prominent academic monetary economist in the world. And she missed that one because in her view, the money supply doesn't matter. None of these things matter, but the level of unemployment. Well, in the 70s, you got both. You got inflation and you got high levels of unemployment, which is exactly counter to the view of all the modern macro models and exactly counter to the view of Chairman Powell. What would Chairman Powell say would happen to inflation if unemployment went up? And it went up to 11% by 1981 in the U.S. economy. 11%. What would he have said? He'd said, oh, well, you won't have any inflation. Inflation hit 15%. 15%. So you did have a lot of inflation. In fact, you had a record level of inflation for peacetime. So there, once again, to go back to the urban myths, there's so many urban myths. So the question originally that you asked was, what works in the 70s? Well, home ownership worked. By the way, that works again. There's a commonality between 1970s and today.
But do you need to have fixed rate debt?
Everybody's got fixed rate debt. For those of you out there without fixed rate debt, it's not as much fun by any means. But that would also be true of commercial real estate. If you're lucky enough to get fixed rate debt with some tenure in it, some duration, for example, 20 or 30-year fixed rate, or you mentioned a HUD mortgage, for example, at a low rate for 40 years. If you can do that, then the world's going to be your oyster, because if you can fix the debt, over time you'll get higher rent rates. So that works.
How did you do in the 70s if you invested just rolling purchase of Treasury bills? How would you have done? And how did the stock market do?
Stock market was basically flat from 1968 to 1981. It was 1,000 in 1968. It was going to hit 1,000 again in 1981. And it had a lot of ups and downs. It hit a low of 580 in 1974, late 74. So it went up and down, but didn't really go anywhere. So you did collect dividends along that road. So the stock market was just kind of flat, didn't do anything for a long time. From 1968 to 81, it's 13 years. That's the longest period of a flat, uninteresting stock market in American history. But what else? If you own bonds, you got shellacked. You got absolutely slaughtered. If you owned a 10-year treasury, good luck. You were in big trouble. If you owned mortgages, if you were banks and owned mortgages, guess what? You got completely annihilated.
How about T-bills?
T-bills are great. If you just rolled over T-bills, by the time you got to the end of the decade, you're rolling over 18%. That is really wonderful. 18% per year, not a bad rate of return for just rolling over 3-month treasury bills. And by the way, that's worked pretty well recently. Rolling over 5.25 treasury bills has been, it's not as good as the stock market's been, but the stock market's beginning to show a little bit of drama to it, whereas T-bills show no drama. You can just roll over 5.25 T-bills and have been able to do that for the last 2 years until the cows come home. It's a great trade. So looking out there, my advice would be if you want a lot of protection in the short run, stay short. Stay within the 1-year T-bill market. In the long run, you should own stocks. You should own something like the S&P 500 and not much worry about where the stock market's going. Just keep buying more over time and never even look at it. The best investors are people who don't even know they're investing. They just, they put it away. They forget they own it and wake up 30 years later and they've got a fortune on their hands, so they don't even know where it came from. Because you get compounding. My students always say, well, Professor Burton, when I get to be 50, I'm going to start saving. No, that doesn't do you any good. You want to save when you're 20, 21. Put $100 away a month when you're 21. That's a lot more valuable than putting 1,000 away every month when you're 51. The compounding is what you want. You want those years of compounding. So I think stocks for the long run still make sense in all environments, including inflationary environments. I think real estate, if you could control your financing, works, because on the revenue side, you're going to be able to push revenue. I think home ownership is a great thing during inflation. We see it now. Anybody that's owned a home the last 4 years has seen major appreciation almost everywhere in the country. And in some areas, most home prices have doubled, and lots of areas tripled in a lot of areas. And that's the same kind of phenomena you saw back in the 70s. I remember there was one year when Scottsdale homes were up 100% on average in 1 year. That was really amazing. But that happens. Vegas, I think, had a year like that back in the 70s as well. So home ownership works. What doesn't work are things where you own something that gives you income, but it's long duration, like a corporate bond or a 30-year treasury or 20-year treasury, or a mortgage. You're a bank. Inflation is never good for banks because inevitably their funding rates get too high compared to what they can make. So banks should not be cheering for inflation. It's not good for them.
How about can anybody buy the Treasury bill? Can they buy it direct from the Treasury through Treasury Direct?
Yes, you want to buy it Treasury Direct. If you're an investor, there are two things you want, two phone numbers you want. Vanguard's, you want to know where their website is. That's for stock and buy index funds. And for the Treasury, Google Treasury Direct and do that. There are no fees. It's a wonderful system. It was designed for seniors who don't know a whole lot about markets and would just like to roll over their T-bills every month. It's very easy to do that, and the government's made it easy. You don't have to call up a broker and pay all these fees to do all these things. It's not necessary. Not that brokers aren't wonderful people. They are. I've always had stockbrokers. But if you really want the best deals, you can go to Vanguard or Fidelity for stocks or even for money markets and goes direct to the Treasury for Treasury Direct. That's the best way to own U.S. Treasuries. Yes.
Professor, there's a rumor that you have a paper coming out soon. Can you give us some insight of what the paper's about and when we may enjoy reading what you say?
Well, the first draft is done. My interns, Aliana Schwartz and Sophia Lombard, have worked diligently all summer, making up for my shortcomings. They've been in charge of putting the data together. And what we're able to show in the paper is the direct connection between the money supply and the price level. It's not much question that it's there in the data, and we produce that data in the paper. And we asked the question, could you have predicted the inflation, global inflation, by gyrations in the money supply? And sure enough, you look at the data, you could see right on the charts when the money supply jumps, and immediately thereafter, the price level starts sloping higher, meaning inflation. I think in general, you can't predict the rate of inflation with any accuracy because we don't know the rate, how businesses change prices. But you can say, if you double the money supply, you're going to end up at some point with double the price level or pretty damn close to it. So, and that's what happened here. You increase the money supply by 50%, and now you've had a 30% increase in the price level. If you correct out for the output growth in that amount of time, that's about what you would have expected, 30, 35, somewhere in that area of a price level. So it's pretty easy to predict where the price level is going to go. You just can't predict how fast it will get there.
Professor, this debt is never ending. It's giving us all heartburn every day. If we have a recession, what happens to the debt? What do we do?
Well, that's the biggest problem out there is the national debt. It's our biggest problem when we're having prosperity, but it's also going to be a major problem when we enter a recession because normally the Fed likes to run a very loose monetary policy in the sense of lowering rates and expanding the money supply. But now it's in a difficult situation because it's going to be very hard to lower interest rates with the size of the debt offerings that we see. And the deficit expands in a recession. Taxes are progressive, and that means when the economy falls, taxes fall faster than the economy. And it falls faster than spending. Spending typically picks up in the middle of a recession. So you're going to have a lot more debt to finance. It's going to put a lot more pressure on rates, pressure in an upward direction. So it becomes a much more difficult policy problem for the Fed. And I think what they'll end up doing is increasing the money supply. In other words, coming in and buying debt and to try to keep rates lower. And they're going to have trouble doing that. But even if the very effort to try to do that means you're going to have more inflation down the road and the problem compounds.
You've stated before that the cure is to reduce spending. If the Republicans, Democrats got together to reduce spending, I doubt that'll happen. We need to talk about this every week.
We should talk about it every week. It's the issue of the day.
The deficit's going to $50 trillion, whether we like it or not. Revenues are roughly $5 trillion. Rates go to 15%. We're so far underwater. Why is nobody talking about this?
Well, for a whole lot of reasons. There'll be a lot of things that are going to be unpleasant that happens when you get that kind of debt level, because there won't be room for much spending on things like Medicare or Social Security or Medicaid. So there'll be drastic cuts into all of those programs, very drastic, because once you get to where the debt service is half of the budget, you're going to have to cut/hack. And there's not a whole lot of places to do that other than, and healthcare is the biggest single expenditure item if you put Medicare and Medicaid together. So the promise we've made to our seniors, we're probably not going to keep. We'll say, oh, yeah, we're going to continue Medicare, but we'll do like England. If you want a surgery and you're over 65, you get put on a waiting list, and 2 years later, if you're still alive, you go in for surgery. Unfortunately, most people aren't still alive 2 years later if they really desperately need surgery now. And that's what they do. They start essentially, fixing who can use what. You start having 0-1 solutions. You come in the front door and you can't come in. When money's not there, they'll ration the supply of health care. And to some extent, it'll go to your friends or it'll go to rich people, but it won't go to the average American. And that's when things are going to get politically difficult, I think.
When we have $50 trillion in debt, rates go to 15%, the Fed prints more money, the problem is compounded. What do we do when, is the answer inflate our way out of it? And do we have 100% inflation? If so, how do we get out of it?
Well, you can't totally inflate your way out of it. You have to not pay some bills. And that's going to be the problem. And the obvious bills you're not going to pay are the healthcare bills.
We need to talk about the national debt every week. Thank you, Professor.
Thank you, Hunter.
Thank you for joining us for Rubber Meets the Road Economics. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.